Okay. So it's clear that this Ukraine invasion is not going to be over as soon as everyone was hoping, and our hearts really go out to those families that have been directly affected by this. It seems history continues to repeat itself, and so we should probably expect disruption more as the status quo going forward, whether it's from climate change or conflict. As investors and financial advisors, how do we best handle now this sort of certain uncertainty? Well, it comes down to understanding what we can control and what we can't. We can't control whether a particular ruler decides to invade another country, or whether some freak storm will flood a part of our country twice. What we can control is how and where we invest our money, and how we react to market movements, and how we spend our money. For example, for a long time now, we've been speaking about this threat of rising interest rates in the US. When the worldwide investment returns have sort of been driven up wildly by the world's largest economy, lending out money at virtually 0% interest, at one point dishing out money like candy, and artificially spending on its infrastructure, it sort of could only go in one direction from there. At some point, interest rates had to be raised. So when the cost of borrowing increases, companies, especially those with lots of debt on their books, obviously start reporting lower profits. It means their share prices drop. At the same time, consumers now have to spend more money on servicing their debt. They have less money to spend, and those companies that rely on that kind of spending, again, profits drop, share prices drop. So the big question wasn't if this would happen, but more when it would happen, and more importantly, how quickly this would happen. A sharp increase creates a shock to business activity, and that's very negative. So when the world woke up to the fact that the supply chains around the world haven't been disrupted but destroyed largely by COVID, it wasn't just a temporary bottleneck, but something a lot more sustained, and that this military activity or exercise turned into a full-on invasion, which affected sanctions on one of the world's biggest energy suppliers. That was the shock that sort of everyone was hoping to avoid. The need now suddenly to restrict demand in the US to match this much lower supply to avoid hyperinflation had to be done with urgency. So while the war was obviously completely unexpected, it did just exacerbate this whole situation. And we've been speaking about inflation concerns for well over a year now. And so our portfolios have been defensively positioned to mitigate the worst of this type of situation. Just to share my screen quickly, just to show you what some of these have been and what we've been sort of trying to avoid. These are some of the big tech stocks and how they've dropped since their peaks in April. Exactly what sort of we've been talking about that we're worried about. And so in our portfolios, you've got these big growth unit trusts, which would be exposed largely to those types of tech stocks. They've been really reduced to an absolute minimum, and these value type of stocks have been getting the sort of lion's share of the portfolio. So in that way, at least, it's been protected to a large degree. What else we can control is how we react when there is negative market movement. March 2020 is still fresh in most of our memories, where markets dropped 20 to 30%. And as we've said before, none of our clients took their money out at that point. We're very grateful for that, because the following sort of 20 months were one of the greatest growth periods in history. And those investors that did take their money out at that point will never make that money back now. And the last thing we can control is how we spend our money. So while interest rates in the US are raised to reduce the demand, it's raised in South Africa for different reasons. We don't have that same massive demand here, but it has to be raised here to retain the rand attractiveness to foreign investors. They want to invest in government bonds, and that difference between what they can get from a first world bond and an emerging market bond, that has to sort of stay as an open gap. Otherwise, money wouldn't come to a country like South Africa, and then the rand would be weakened. Cost of imports would be a lot more, et cetera, et cetera. So we know interest rates now have risen and will continue to rise. at least to a degree, maybe not as much as in the US. Inflation is a guarantee because of all these supply chain constraints. What can we do? Well, we can just obviously limit spending, keep as much free cash flow in our personal and our business budgets as possible, avoid and pay down debt as much as possible rather than spending it, and rather invest money. There's some really great guaranteed low risk investments which are now coming available because of the rising interest rates. And so by investing in these, we're kind of using the current circumstances, at least to our advantage to some degree, until they revert to how it was before. So that's a little bit about how we proactively treating our clients' investments. Please let us know if you have any questions at all. And otherwise, thank you really very much again for the support.